Okay, good morning, good afternoon, and good evening, everyone. In this video, we are from Group 12. We're going to discuss about the financial analysis for the class of Business Analysis and Valuation. Next, our member consists of Gabriel Fiorentino, Dominic Vinian, myself Bina Zahra, and Amelia Cornelius. Next, this is the contents for the presentation in this video. Next, first of all, I'm going to introduce about the financial analysis. Next, the financial analysis itself is a method to analyze the profitability and the growth of the company, where we usually use the ratio analysis. The objective of ratio analysis itself is to evaluate the effectiveness of the firm's policies. And there are three types of ratio analysis. First is time series comparison, the second is cross-sectional comparison, and the third one is comparing the ratios to some absolute benchmark. But the last one is rarely used because there are no absolute benchmark for most of the ratios. Next. And here is the company profile that we're going to use in this video, where we use Semen Indonesia or SMGR and Indosemen Tunggal Prakarsa or INTP that both runs in the cement industry, where the SMGR is a state-owned company that has been run since 1957, while INTP is a publicly listed cement company that has been operating since 1975. Next one. The first one I'm going to discuss is about the profitability. Next. Here, for measure the profitability, we use return on equity, where this is a comprehensive indicator that provides indication of how well managers are employing the funds invested by the firm's shareholders to generate the returns to the company. The formula for ROE itself is net profit divided by shareholders' equity. In this slide, we already got to see the ROE result for INTP and SMGR for the first quarter of 2022 and the first quarter of 2021. And the factors that drive the return on equity, there are two factors, which first one is how profitably firms employ its assets, and the second is how big the firm's asset base relative to the shareholders' investment. And there are two ways to decomposition the ROE, which the first one is the traditional approach, and the second one is the alternative approach. Next. The first that we're going to discuss is the traditional approach, where here we use the return on asset and the equity multiplier. ROA itself, or return on asset, is a ratio that tells how much profit the company is able to generate for each asset invested to the company, while the equity multiplier, or the financial leverage, indicates how many assets the firm is able to deploy for each share invested. Next one. This is the result for the decomposition of the ROE, where we could conclude that INTP decrease in ROE from 2021 to 2022 is due to significant decrease also in the net profit margin. And even though the financial leverage still increased and still has better performance than SMGR. Thus, we can conclude that SMGR has better operating performance that we could see from the net profit margin and also the result from the ROE itself. But in this decomposition method, we need to note there are two limitations, where there is no distinction between operating and investment function of the assets and net profit of the ROA. And the second one is there is no distinction of possessor of the numerator and the numerator of the ROA. Next. The next one is the decomposition alternative approach, where here we use the ROBA, or return on business asset, the spread, and the financial leverage. In this decomposition, we could distinguish the operating and the investment function of the company. And then we need to note here that ROBA tells how profitably a company is able to deploy its operating and investment asset to generate profits. But because of the limitation of the information we could get, we could not decompose the ratios fully from the ROBA. So the next one, the calculation that we could we could search for is only the interest expense after tax, the NIPAT or net investment profit after tax, and net operating profit after tax. And it also results to the same return on equity that we already seen before. And the implication from this equation or from this decomposition is that INTP has better investment performance, indicated by the positive NIPAT result, and SMGR has better operating performance, indicated by their NOPAT result. Next one.
I will continue the discussion about assessing operating management through the compose of the net profit margins. First, the NPM or the net profit margins is measured by dividing net profit to revenue. This margin shows limited information regarding operating performance as we couldn't understand which part of which cost that drive the revenue to go to drive the net profit to go up or to go down. In order to understand, we need to use the ratios of revenue to understand fully the efficiency of operating management. This could be done through common size income statement, where each item of the income statement is expressed as a ratio of revenue. We present the table below that the NPM from INTP and SMGR have a different pattern. However, we could not understand why the pattern could be different as shown below, and therefore we need a further decomposition. We could decompose the NPM through its functions. We display the COGS per revenue margins and also the selling and general administrative expense per revenue margins. We also display the gross profit margins. However, it shows the same information as the COGS per revenue margin, as if we added up these two margins altogether, we could get a result of 100% or 1. The result from this calculation shows that from the COGS per revenue, both companies' COGS are increased from the first quarter of 2021 to first quarter of 2022 due to higher energy costs as disclosed by the both companies. However, the increase in INTP is larger than SMGR, meaning that SMGR could are less sensitive from the higher energy cost than INTP. Next is the selling general and administrative expense per revenue. First, SMGR managed to incur less SG&A expense than INTP, as shown that for both two periods, the cost incurred by INTP is significantly larger than SMGR. If we look down from the note to financial statements, we could understand that SMGR could save more on its transportation cost. Moreover, SMGR was also able to reduce this expense through cost saving. So, in the first quarter of 2022, the ratio SG&A per revenue ratio for SMGR is decreasing, and we could see in the note to financial statements that each element of this expense classification were reduced by SMGR. Other margins that we present below is the EBITDA margin and the NOPAT margin. The result from the calculation shows that both EBITDA and NOPAT margin for INTP is slashed, while the SMGR figures remain stable. The other thing that we want to share that the net profit margins that despite the aforementioned margins difference shown by the EBITDA and NOPAT margins, the NPM in quarter one of the 2022 is differed slightly between the two companies. This might be a very different pattern from the EBITDA and NOPAT margin, where the INTP result was very below behind the SMGR. The reason behind this pattern is that the INTP investment income is higher, while the SMGR interest and tax expense is higher. This is due to financing policy of SMGR to fund their operation with more debt than INTP, and they also incur more tax expense as they have more non-deductible expenses than INTP.
Now we move to the next section, evaluating investment management, decomposing asset turnover. Okay, the analyst needs to evaluate investment management in order to evaluate its effectiveness since firms invest considerable resources in their assets. Hence, using them productively is critical to overall profitability. We can evaluate the effectiveness of firms' investment management using two main categories. The first one is working capital management. Working capital is defined as the difference between a firm's current assets and current liabilities. We can calculate specifically for operating working capital using formula as stated on slide. Second, management of non-current operating assets that concern about the utilization. We can find the net non-current operating assets using formula as can be seen on the slide. Next. Now we move to the analysis. We will use several ratios to analyze INTP and SMGR working capital management. The first one is operating working capital to sales ratio and operating working capital turnover. Based on our calculation, we can conclude that both INTP and SMGR become more efficient in its working capital management, as can be seen from the decrease in operating working capital to sales ratio and the increase in operating working capital turnover. Because operating working capital turnover indicates how many rupiah of revenue a firm is able to generate for each rupiah invested in its operating working capital. So, SMGR was more efficient in its working capital management compared to INTP. Next. Based on ratios presented on the slide, SMGR was more efficient in its receivables collection, as it had higher trade receivables turnover. Since the ratio measures how many times a company's receivables are converted to cash in a certain period of time. SMGR had a better inventory turnover than INTP in Q1 2022. Both SMGR and INTP shows a declining trend, which might be a sign of weakening sales or overstocking of inventory over the period. The higher inventory turnover are the better, as the longer an inventory items remain in stock, the higher its holding cost, thus burdening the company. Both INTP and SMGR experienced the declining of trade payables turnover. This decreasing might indicates that the company is taking longer to pay off its suppliers than in previous periods, which might be caused by company's financial conditions. Next. The last three ratios are days receivables, inventories, and payables. SMGR has a better performance in collecting receivables compared to INTP, as a lower ratios means that company collect cash earlier from customers, as cash flow is important for the company. SMGR has a better performance than INTP in managing their inventories, as smaller number indicates that a company is more efficiently and frequently selling off its inventory. Higher days payables may indicate that SMGR can use the available cash for short-term investment and to increase their working capital and free cash flow. However, it must consider that if the company takes too long to pay its creditors, it risks its relations with the suppliers and creditors. So after we analyze the working capital, we need to analyze the company's management of non-current operating assets. SMGR non-current operating assets utilization slightly improved. This can be seen as both its net non-current operating asset turnover and its PPE turnover increase. On the other hand, INTP non-current operation assets utilization is stagnant. However, INTP still has a better performance than SMGR. It is because INTP create more rupiah of revenue for each rupiah non-current operating assets and PPE.
Next session, we are going to evaluate the financial management of SMGR and INTP. We are going to evaluate both company by using the financial leverage ratio. Before we begin, we have to understand first what is the financial leverage ratio. Well, financial leverage ratio is the ratio to evaluate the degree of risk arising from a firm financial leverage. On the other hand, we can see that financial leverage can give a picture to us that the firm has to consider whether the benefit of financial leverage exceeds the cost or risk from the financial leverage. There are two types of financial leverage ratio that we are going to use. The first kind is to evaluate the current liabilities and short-term liquidity of both companies. It is an attempt to measure the firm's ability to repay its current liabilities. The second one is debt and long-term solvency. It is useful to evaluate the mix of debt and equity in a firm's capital structure. Next slide. For the first one, we are going to evaluate the current liabilities and short-term liquidity for both companies. We have several ratios that we have already counted. The first is current ratio, second quick ratio, cash ratio, operating cash flow ratio. And here are the results. Based on our calculation, both companies shows reduction in their quality of liquidity. They also have the same patterns, which are a considerable increase of current liabilities in 2021 and a drop in cash position in 2022. Given that INTP was an insignificantly better situation than SMGR, the ratio results for INTP are safe, while for SMGR, the result may be dissatisfactory because most of INTP ratio are more than 1. If the ratio is more than 1, it means that INTP has more liquid assets to pay its current liabilities, while SMGR, on the other hand, has less liquid asset to pay its current liabilities. Therefore, in the other words, we can say that SMGR is more risky to pay its current liabilities. Next slide. Okay, next we are going to evaluate the debt and long-term solvency for both companies. We have calculated the liabilities to equity ratio, debt to equity ratio, debt to capital ratio, interest coverage by earning basis, and by cash flow basis. And here are the results. From the results, we can see that compared to quarter 1, 2021, INTP used more debt financing, while SMGR used more equity financing. And compared to SMGR, INTP has higher earning basis interest coverage, but lower cash flow basis interest coverage. This indicates that from the earning perspective, the degree of risk associated with debt policy is lower for INTP compared to SMGR, but the composite condition happens from the perspective of cash flow. Next slide.
We will continue the discussion with assessing sustainable growth rate. Sustainable growth rate is the rate at which a firm can grow while keeping its profitability, as mentioned earlier, and financial policy unchanged, for example, the dividend payout policy. First, for the INTP, the rate of the sustainable growth rate was minus, based on annual data of 2020 and 2021, due to more dividend paid than profit generated. However, INTP has huge excess cash that the company doesn't use for its operation. The next one is the SMGR. In normal situation, the company maintained moderate payout and able to grow sustainably at approximately 2 to 4% per year. However, from the data this in this table, we could see that in 2020 the sustainable growth rate were increased due to lower dividend payout because the company were anticipating the impact of the COVID-19 pandemic.
Now we move to the cash flow analysis. Next. To examine the cash flow, analysts need to focus on first, cash flow from operation before investment in working capital and interest payments to examine whether the firm is able to generate a cash surplus from its operation. Second, cash flow from operations after investment in working capital to assess how the firm's working capital is being managed and whether it has the flexibility to invest in non-current assets for future growth. Third, free cash flow available to debt and equity holders to assess a firm's ability to meet its interest and principal payments. And the last one is free cash flow available to equity holders to assess the firm's financial ability to sustain its dividend policy and to identify potential agency problems from excess free cash flow. Next slide. We will start with INTP. According to its consolidated statement of cash flow, we can see that INTP was able to generate a cash surplus from its operation in Q1 2021. However, it experienced negative cash flow from operating in Q1 2022. Second, INTP still had a positive cash flow from operations after investment in working capital in Q1 2021, but not in Q1 2022. Hence, it was not sufficient to finance its long-term investment, so it has to rely on external financing. INTP has less flexibility to pursue long-term investment than those that can fund their growth internally. Third, INTP still had free cash flow available to debt holders in Q1 2021, but not in Q1 2022. So INTP might not have ability to meet its interest and principal payments, or have to borrow additional funds to meet their interest and debt repayments obligations, or cut some of their investment in working capital or long-term investment. The last one, because the cash flow was minus, INTP did not have free cash flow available to equity holders. Next slide, please. Now we move to the SMGR statements of cash flow. We can see that SMGR was able to generate a cash surplus from its operations in Q1 2021 and 2022. SMGR still had a positive cash flow from operations after investment in working capital in Q1 2021 and Q1 2022. Hence, it is sufficient to finance its long-term investment internally. Third, SMGR still had free cash flow available to debt and equity holders both in Q1 2021 and 2022. So, SMGR able to meet its interest and principal payments. The last one, we can see that SMGR still had free cash flow available to equity holders or dividends. So, according to our analysis, we can conclude that SMGR cash flows are better than INTP.
Before we end our presentations, we're going to wrap up our financial analysis and give recommendation for INTP and SMGR. Next slide. To wrap up our financial analysis, we compare Q1 2022 to Q1 2021. And we can see here there are comparison between both companies. For overall profitability, INTP has worse in 2022, but SMGR has better performance. And SMGR is better than INTP. For operating management, INTP has worse performance, while SMGR has better performance, and SMGR is better than INTP. For investment management, INTP and SMGR both have a better performance compared to 2021. And compared to INTP, SMGR is better. For financial management, both companies have worse performance in 2022 compared to 2021. But INTP still has a better performance compared to SMGR. For cash flow, INTP and SMGR has worse performance compared to previous year, but SMGR can compete and have a better performance in terms of cash flow compared to INTP. Next slide. And here are some recommendations that we give for INTP and SMGR. First, INTP and SMGR needs to improve research and development and marketing to differentiate themselves from competitors' product to gain more competitive advantage. And second, they can adjust inventory budget for better inventory management, so there will be no oversupply or over inventory stock. The third one is to accelerate the receivables of collectibility. And fourth, or the last one, is to hold more liquid assets so it can maintain its liquidity. Next slide. Here's our reference. Thank you for listening, and we hope our presentation is useful for you. Thank you.